For months, viewers around the world have been hearing a confident story coming out of Moscow. A story of stability, adaptation, and quiet success under pressure. On official stages, in carefully framed speeches, and in tightly edited broadcasts, Russia is presented as a country that has adjusted, endured, and even strengthened itself in the face of historic challenges. It is a narrative of resilience, of an economy that supposedly bent but never broke, of institutions that absorbed shocks and simply moved on. But behind that polished surface, behind the formal language and the calm tone, something far more complex is unfolding. A set of numbers, decisions, and quiet warnings is beginning to tell a very different story. One that is not announced with fanfare and not explained in press conferences, yet is shaping the future of an entire nation. In recent months, a subtle shift has started to appear in the way Russian officials speak about the economy. The words are still confident, but they are more careful. The promises are still bold, but they are more general. References to specific figures, timelines, and forecasts have become rarer, replaced by broad assurances and abstract phrases about long-term strength. At the same time, outside observers, analysts, and even some insiders have begun to notice that key indicators no longer move in the same way they used to. Growth is slower, pressure is higher, and the margin for error seems thinner than before.
Nothing dramatic is announced. Nothing is officially called a crisis. But the tone has changed, and in economics, tone often changes before reality is publicly acknowledged. The most interesting part is not what is said, but what is not said. Entire sectors that once dominated discussions now receive little attention. Financial institutions, energy flows, and state reserves are mentioned in passing, if at all. Yet these are the very pillars on which the Russian economic model has rested for decades. When those pillars are no longer openly celebrated, it raises an obvious question. Why? What is happening beneath the surface that makes silence more convenient than explanation? What calculations are being made quietly behind closed doors, while the public hears only reassuring phrases and familiar slogans? Internationally, something similar is happening. Markets react more cautiously to Russian data releases. Foreign partners adjust their positions slowly, almost invisibly, rather than making dramatic statements. Even countries that continue to trade with Russia do so under new terms, new structures, and new limitations that are rarely discussed openly. It is as if the global system has begun to treat Russia not as a stable constant, but as a variable, something that must be continuously reassessed, continuously hedged against, continuously monitored. That alone is a significant change, even if it does not appear on television screens. Inside Russia, everyday life also reflects this quiet transition. Businesses are more careful about borrowing, households are more cautious about spending, and regional authorities are more restrained in their promises. People do not necessarily talk about it as an economic shift. They describe it as uncertainty, as waiting, as a sense that now is not the time to take risks. This atmosphere is not created by headlines or speeches. It is created by lived experience, by subtle signals that something is tightening, that something is becoming more constrained, even if no one names it directly. All of this leads to a larger question that is rarely asked openly. If the official story is one of stability and adaptation, why does so much behavior, both inside and outside the country, suggest preparation, caution, and quiet adjustment instead? Why do the strongest statements feel increasingly disconnected from the underlying mood? Why do numbers become harder to access, forecasts less precise, and explanations more abstract? These are not the signs of collapse, but they are also not the signs of confidence. They are the signs of a system that is changing in ways that are not yet fully visible. In the next part, we will look directly at what those changes are, what the data actually shows, what decisions are driving them, and why so many experts now believe that Russia's economic path has entered a fundamentally new and much more fragile phase. If you want to understand what is really happening behind the scenes and how this quiet shift could reshape not only Russia, but the wider global balance, make sure you are subscribed and stay with us for the next part of this report. What is actually happening inside the Russian economy becomes visible only when we move away from official speeches and look directly at the structure of money, credit, production, and state finance. The story is not one of sudden collapse, but of slow exhaustion, a process in which every major system still functions, but at a cost that is rising faster than the state's ability to pay it. According to data from the International Monetary Fund and the World Bank, Russia's GDP growth, which briefly accelerated during the early phase of the war economy due to massive state spending, has sharply decelerated. Growth driven by military production is not the same as growth driven by investment, productivity, or consumer demand. It inflates numbers on paper while draining capital in reality. Factories work, people are paid, and output is counted, but what is produced does not generate future income. It is used, destroyed, or stored without return, and this is the key structural difference that now defines Russia's trajectory. The banking system is where this strain becomes most visible.
Russian banks, especially large state-linked institutions such as Sberbank and VTB, have been directed to provide enormous volumes of credit to defense companies and strategically important enterprises. These loans are often issued under political pressure rather than commercial logic. Many of the borrowers do not generate market-based revenue sufficient to repay them. As a result, the share of non-performing and restructured loans has been rising steadily. Bloomberg and Russian financial disclosures indicate that a significant portion of corporate credit is now classified as high risk or impaired. This means that banks continue to show assets on their balance sheets that are unlikely to ever return as cash. In accounting terms, this is survivable for a while. In economic terms, it means that capital is frozen inside unproductive channels. At the same time, households have become more dependent on borrowing to maintain their standard of living. Inflation in essential goods such as food, utilities, and transportation has been consistently higher than the official headline rate. While official inflation may be reported around the high single digits, the lived experience in many regions reflects much faster price growth. To compensate, families increasingly rely on consumer credit. Overdue payments have risen, and banks have responded by tightening conditions and raising interest rates.
The Central Bank of Russia has maintained a very high key interest rate to defend the ruble and control inflation. This protects monetary stability in the short term, but suffocates long-term growth. Small and medium-sized businesses, which depend on affordable credit, find it increasingly difficult to invest, expand, or even survive. Energy, the historic backbone of Russian state finances, has also changed in a fundamental way. Oil and gas revenues once provided a stable and predictable stream of foreign currency. That stream has become less reliable. Sanctions, price caps, and shifting trade patterns have forced Russia to sell much of its oil at a discount, primarily to Asian markets. China and India have become the dominant buyers, but they negotiate from a position of strength. Russia accepts lower prices, longer payment timelines, and less favorable contract terms because alternatives are limited. This reduces the real value of each barrel exported, even if volumes remain significant. At the same time, the cost of maintaining energy infrastructure has increased due to restricted access to Western technology, spare parts, and services. This raises expenses while revenues soften, compressing the fiscal space available to the government. The Russian state budget reflects this compression. Military and security spending has expanded dramatically, absorbing a growing share of national resources. This has required reallocation away from infrastructure, healthcare, education, and regional development. Roads are repaired later, hospitals modernize more slowly, and municipalities postpone projects that do not directly relate to immediate priorities. These are not visible as a single crisis, but as a gradual thinning of the state's ability to maintain the civilian economy. Over time, this erodes productivity, worsens demographic challenges, and reduces the country's long-term growth potential. Another critical dimension is labor. The war economy absorbs both money and people. Recruitment incentives for the armed forces have risen sharply, especially in poorer regions. This pulls workers out of civilian industries, creating labor shortages in manufacturing, construction, and services.
Wages in some sectors rise as employers compete for fewer workers, but these increases are often offset by inflation and do not translate into higher real living standards. The result is a distorted labor market where mobility is driven by necessity rather than opportunity. Internationally, Russia has become more economically dependent on a narrower set of partners. This reduces diversification and increases vulnerability. When a country relies heavily on one or two major buyers or suppliers, it loses bargaining power and flexibility. Trade becomes more political, more conditional, and less efficient. This is already visible in the structure of Russian exports and imports, where raw materials flow outward and finished goods flow inward, often at prices that favor the trading partner. This pattern limits domestic industrial development and locks the economy into a lower value-added position. All of these processes together define what many economists call a zombie economy. This does not mean an economy that is dead, but one that moves without renewing itself. Activity continues, money circulates, and production happens, but the underlying engines of growth, innovation, and productivity weaken. The state becomes the primary driver of demand, and when the state itself is financially constrained, the entire system becomes fragile. This fragility is not yet a collapse, it is a narrowing of options. Every year, more resources are required simply to maintain the current level of functioning. Reserves are drawn down, financial buffers shrink, and the room for error disappears. Any external shock, whether a drop in energy prices, a new round of sanctions, or a domestic financial disturbance, would now have a much larger impact than it would have had a decade ago. In this sense, the core transformation is not economic alone, but strategic. Russia has traded flexibility for endurance and endurance for rigidity. It has built a system designed to survive pressure, but not to evolve beyond it. This makes the future increasingly dependent on a single factor: the state's ability to continue funding and managing this structure without interruption. As long as it can, the system persists. When it cannot, the adjustment will be sudden, not gradual, because so much of the economy is now synchronized to a single political and fiscal rhythm. This is why the current phase matters so much. It is not the moment of crisis, but the moment when the conditions for crisis are being quietly assembled. The numbers are not dramatic yet, but the direction is clear. Credit is tightening, reserves are shrinking, trade is narrowing, and growth is becoming more artificial. This combination does not produce headlines, but it shapes the future. And it sets the stage for what comes next, when these pressures begin to interact with each other rather than remain contained within their own sectors. The long-term consequences of this transformation are not limited to balance sheets and budget lines. They are beginning to reshape the social, political, and geopolitical position of Russia in ways that will persist long after any single event fades from the headlines. When an economy becomes centered on state survival rather than private development, it changes incentives across society. Entrepreneurs become cautious, innovation slows, and risk-taking shifts from productive investment to speculative or defensive behavior.
In Russia, this has meant that many talented engineers, scientists, and business owners either leave the country or redirect their skills into areas that are safe but not necessarily valuable for future growth. This quiet drain of human capital is difficult to measure, but its impact accumulates year after year. Cities that once served as regional economic hubs, such as Yekaterinburg, Novosibirsk, Samara, and Kazan, feel this shift most acutely. Their universities still produce graduates, their factories still operate, and their technology parks still exist. But the pathway from education to opportunity has narrowed. Instead of building globally competitive companies, many young professionals now see their prospects tied to state contracts, regulated industries, or migration. This limits not only personal freedom, but also the diversity of the economic ecosystem. A system dominated by a few large actors is less adaptive and less resilient, even if it appears stable. Moscow and St. Petersburg continue to absorb resources, talent, and investment at the expense of the regions. This centralization deepens inequality between urban centers and peripheral areas. Regional budgets become increasingly dependent on transfers from the federal government, which itself is constrained. This creates a feedback loop in which local authorities have less autonomy, less capacity to plan, and less incentive to innovate.
Over time, regional economies become administrative extensions rather than engines of growth. On the international stage, Russia's economic profile is also changing. Once it positioned itself as a diversified emerging market with strong scientific, industrial, and energy sectors, now it is increasingly seen primarily as a supplier of raw materials and a consumer of foreign technology and manufactured goods. This shift reduces its influence in multilateral institutions and trade negotiations. Countries engage with Russia pragmatically, but rarely strategically. They see it as a partner of convenience rather than a pillar of global stability. The growing economic asymmetry between Russia and China illustrates this dynamic. Beijing has become Moscow's largest trading partner, investor, and technological supplier. This relationship provides Russia with access to markets and goods, but it also creates dependence. Contract terms, pricing mechanisms, and infrastructure routes increasingly reflect Chinese priorities. Russia adapts because it must, not because it chooses to. Over time, this reduces sovereignty, not in a political sense, but in an economic one. When choices are constrained by necessity, autonomy becomes symbolic. Domestically, the social contract is also evolving. The state offers stability, employment, and security in exchange for political loyalty and limited participation. For some citizens, this is acceptable, even desirable. For others, especially younger and more globally connected generations, it feels restrictive. This creates a generational divide that is subtle but persistent. The future workforce may be smaller, less dynamic, and less willing to engage in the kinds of long-term projects that drive economic transformation. Infrastructure presents another long-term challenge. Maintenance of transport networks, energy grids, water systems, and housing stock requires continuous investment. When funds are redirected elsewhere, deterioration does not happen immediately. It happens slowly, one postponed repair at a time. But eventually, the cumulative effect becomes visible. Bridges age, pipelines leak, power outages become more frequent, and logistics become less efficient. Each of these increases costs for businesses and households alike, further reducing competitiveness. Demographics amplify these pressures. Russia's population is aging and birth rates remain low. An older population requires more healthcare and social support, while contributing less to production and taxation. In a system where fiscal space is already constrained, this creates difficult trade-offs. Every ruble spent on pensions and healthcare is a ruble not spent on education, innovation, or infrastructure. These choices are not ideological, they are mathematical. The global environment will not become easier either. Climate transition policies, technological change, and shifting trade patterns will continue to reshape markets. Economies that can adapt quickly, attract investment, and foster innovation will benefit. Economies that are rigid, inward-looking, and dependent on a narrow set of exports will struggle. In this context, Russia's current model appears increasingly misaligned with global trends. Yet it is important to understand that none of this implies inevitability in a dramatic sense. Economies change, policies shift, and paths can be redirected. The question is not whether Russia can recover or transform, but at what cost and over what time frame. The longer structural imbalances persist, the more painful any adjustment becomes. Gradual reform is easier than sudden correction. But gradual reform requires political will, social consensus, and economic openness, all of which are currently limited. What we are witnessing, therefore, is not an ending, but a transition. A transition from a model based on integration and growth to one based on insulation and endurance. That model can function for a time, especially in a large, resource-rich country. But it cannot generate the dynamism, prosperity, or influence that characterized earlier phases of development.
It preserves the present at the expense of the future. The true significance of this moment lies in its quietness. There is no single shock, no single announcement, no single event that marks the turning point. Instead, there is accumulation. A little less investment here, a little more control there, a little more dependence, a little less flexibility. Over years, these small shifts reshape the entire system. For observers, policymakers, investors, and citizens alike, the challenge is to recognize this process while it is still unfolding, not after it has hardened into permanence. The numbers matter, the budgets matter, and the trade flows matter. But so do expectations, incentives, and trust. When people stop believing that tomorrow can be better than today, economic decline becomes self-reinforcing. This is why the Russian economic story now is not just about growth rates or sanctions or oil prices. It is about direction. It is about whether the country moves toward openness, diversification, and renewal, or continues along a path of concentration, dependence, and slow erosion. That choice will shape not only Russia's future, but also the balance of power, trade, and stability far beyond its borders.